Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Despite the global standstill, there's still much to consider for macro investors. We published a range of notes this week, from looking at the latest economic data releases, COVID lockdowns being reversed, the link between demographics and COVID deaths, war mobilization economics, and of course, the oil price crash too. Make sure to subscribe to the site, it's great value. You'll also get access to our vibrant Slack group. On to this episode's guest, we have the excellent Alex Gurevich. I've known Alex for years. He's one of those investors that's happy to go against the grain, yet when he explains his case, you can't see why you disagreed in the first place. As for his background, Alex is a founder of Honte Investors, which is a global macro investment firm. He's been trading for over 20 years, and before running money, he held various roles on Wall Street that included the launch of a fixed income derivatives trading franchise, as well as running the macro book at JP Morgan. He's an author too. He wrote The Next Perfect Trade, published back in 2015, which describes his investment process. Alex was born and raised in St. Petersburg, Russia, and earned his PhD in maths from the University of Chicago. So on to our conversation. We've been in this pandemic now for several months now, and you've been obviously trading markets and investing around this time. What things have you learned the most about your investment process, or just philosophically about markets over this period?
Well, I would break it down into two separate things. First of all, a lot of things have happened that I've not seen before. It was like a very weird, like the amount of weird stuff that happened in the 1 week of March probably compressed the whole global financial crisis. And I could probably have a whole separate podcast just about the weird market price action I've seen. And when I've seen it all, I thought I've seen it all. And then I've seen negative $40 oil like 2 days ago, right? That's after the day after I think I've seen it all in that week of March, when I saw 30-year inflation break-evens fall below 1%. I saw treasuries crash in the environment of stock selling off. I saw I saw deeply negative spreads and treasury liquidity going down by 99%. All this stuff I've seen, right? Philosophically, it is consistent with my observations that occurred through several crises that as I went through in my life. I went through, well, you could even think of it as two crises: Asian contagion 97, Russian crisis 98, 2001 crisis, 2008, 2007, even though it was like a separate several waves, and European debt crisis, and Brexit crisis was less so, but there were some minor mini crises in between. Things get crazy, and in every crisis, something happens that has never happened before. In every crisis, I've seen price action that I have not seen before. Like, it's never like, oh, in the previous crisis, this spread blew up and now it blew up, right? Like, we've never seen, for example, LIBOR funds blow out like the way, actually, I think something like this happened in the 70s, but it's not well documented by derivatives markets. But we've never seen it blow out like it did in 07, 08, and it blew out here, but not as much. But we've never seen but in 07, 08, treasuries were rallying and spreads were actually going in favor of treasuries. We never saw spreads on treasuries go more negative in crisis. That's just one example, right? We never seen oil do what it did, right? So it just reinforces my view that there's always something happens that no one can foresee or calculate, and positions are always vulnerable. You can never feel safe with any kind of position when crisis hits. It reinforces my view that most of the risk management should happen during good times. That is, you should run positions very cautiously when volatility is low and time are good. Not try to squeeze this extra 1% return. While in the middle of crisis, in the middle of panic, you have to press risk. You have to get aggressive. You have to be ready to take views and take stances because the advantage is there. You can make several years worth of advantage by trading correctly when the crisis starts. Forget about the positions you had on. Forget about what goes on against you or for you right now. Forget about your performance. Just focus on, here's my portfolio, what I can do. Past is past. What I had to stop out of, you stop out of. What you don't like anymore, you get rid of. You have to focus on what's going on. If you don't know what's going on, if you're confused, it's perfectly fine not to trade. But if you see opportunities, you can, and I think you must trade.
Through this period, how are you thinking about markets? Are you viewing this as just a pause before we restart pre-existing trends, or does this somehow lead to a new path for us? Is there sort of path dependency within the sort of the pandemic?
There is definitely some path dependency. The general rule, kind of rule of thumb, is the more things change, the more they stay the same, right? So usually we end up roughly the same things. There is some sort of disaster, some sort of crisis, which seems very bad at the time. We all panic. Things blow over. It takes longer or shorter to blow over. Stocks end up for 400 years, eventually recovering, making new highs. Sometimes it takes decades. Well, not many decades, but like 15, 18 years from high to high on stocks has happened several times. Like from 29 high or from 64 high, it took almost 2 decades to make a new high.
Yeah.
So things like that happen. Usually what happens is the first panic sell-off, then recovery, as I mentioned before, and then there is usually a new bottom on stocks, new bottom. But usually the second bottom is less panicky. Sometimes it's more panicky in 2008. Sometimes it's less panicky like in 2002.
Yeah.
Things proceed usually in more or less the same ways. Again, I'm not a pandemic expert. Will it create lasting changes in human behavior? Probably some, but not like to the point of completely altering the society. I think people will start flying again and people will start doing business again. And maybe, yes, it gave rise to Zoom conference, video conferencing. I wonder if it could, in the long run, hit commercial real estate because people will start telecommuting more because they discovered how well everything works when you telecommute.
Yeah.
There will be some casualties, some winners, some losers. There will be a flood of liquidity. People will talk about hyperinflation. Hyperinflation probably will not happen. There will be like a one-time inflationary impulse, but in the end, we'll still live in a deflationary world. So actually, what I think is the opposite of a little bit of what people fear is going to happen. I think the inflation headlines are going to start getting very high a few months from now, but there will be no hyperinflation. That's my best guess, but it's hard to really know what's going to happen.
I mean, around inflation, actually, do you have a core inflation view? Because you have been bullish on rates, US rates, even before the pandemic. Underlying that, do you have like a disinflationary view for the world?
Being long US Treasury bonds is not as much an inflation view, though of course, assuming that there is no hyperinflation is a good point to start. But it just has characteristics in my trading system of a strictly superior trade, because it's a risk parity aspect of this trade that makes it so superior. It carries positively. It's in a continuous bull market, and it continuously hedges your portfolio. It makes money whenever something happens. Every time there is some kind of crisis, rates shock down, but then they never actually go all the way up back again. So it's like the greatest free lunch in the history of humanity is the government debt of English-speaking countries. So Marvis, government debt sovereign debt of English-speaking countries was great for like 800 years. British Empire debt, virtually always a buy. Debt of any other English-speaking country, no hyperinflations, no property defaults. For whatever reason, that's been always a great asset, and it's always paid back. It's very seldom had negative yield. And the thing is that what we are seeing in this environment, there is a degree of reliance on policy in this trade. Because if you really think about what is the function of the Federal Reserve, they talk about all those mandates and this and that, but really Federal Reserve has one function, which actually came to a test this year. They need to guarantee funding on US Treasuries. That's all Federal Reserve does. They guarantee funding on US Treasuries.
So inflation stability, full employment, that in your view is more of a secondary or almost a red herring, that if you push hard enough, the real function is to support the Treasury.
Well, in some sense, those things are interlinked. They control those things. They achieve those things via the mechanism for achieving those things is guarantee funding in US Treasuries. And they might have right now in crisis expanded their mandate a little more broadly and say they now guarantee funding for corporates, right? But the original core mechanism for what they do anything is funding for US Treasuries. Last September, when there was a repo crisis, right, and for a while funding was blowing up for US Treasuries and the repo went up briefly like intraday to 10%, Jay Powell correctly said that really has no economic implications. So some hedge funds have to pay high funding overnight, right? So who cares? Nobody blew up on that because maybe somebody always blows up on something. But I know because I had treasuries, I needed to fund them. Yes, it was costly to fund them for a day. So what, right? If anything, it was an opportunity to make more money, right? However, Fed took it seriously and injected liquidity because that is their job, to make sure that treasuries are funded. There is no incentive for US government ever treasuries to be in a funding crisis, because what goes on funding crisis? Anything which doesn't constitute a good collateral, right? They have to make sure that treasuries are good collateral. There is no cost for them to ensure that, because we don't have external debt. So we don't need to fear default. We can avoid default by printing dollar. In fact, anytime within the last 40 years, if you bought a 10-year note and I'm going to hold it, but not buy and hold it as an investor, but buy and hold it as a trader, in the sense that I will continue funding it. I will continue repaying it out and funding it at whatever repo rate is on a 10-year note and hold it to maturity for 10 years. You would have made money every single time, on average, probably like 2.4% over the last 30, 40 years. That was my numbers until last few years. I did this analysis when I was writing my book. And the most awful 10-year notes you could buy were in 2016, when people called the end of US bull market, because they traded down to, I think, 1.3%. You bought them in 2016 and you would have looked totally awful in 2018 when rates went over 3%, right? But notice what would happen in terms of actual funding. You would have bought in 2016, you bought at 1.3%. At the moment, it was funding at 25 cents. You would have been making money for a while, and you would have only started losing money in 2018. And you would have, when the rates went above that level, right?
When Fed hikes, yeah.
When with some hikes in 2018, you would have started losing money. You would have been losing money for a year, and then eases in 2019 will bring you to losing only very little money. So you're kind of in a wash, maybe down a little bit. And now, of course, funding goes to zero and you're starting to make money again. So even in this worst possible juncture you could see in the history, so you would bought it at the most expensive point ahead of legit bear market, you would have still made money. So there is this meta existential reason to own treasuries always, right? That's always the right trade, quote unquote, always, because of course it's the right trade until it isn't. But observing 800 years of history and 40 years of recent history, I have a strong enough pattern to see that it's better to own them than not to own them.
But I mean, are we at levels now where treasuries are trading around 60? I guess the curve is still steep, which kind of goes to your point about earning kind of the roll down. But is there a level in which, as you get close to zero or even negative, where it's no longer attractive to hold those bonds?
It's all relative, right? Of course, it's less attractive to hold them now than before. And of course, for example, right now, actually, my net position on US interest rates, aside from some specific curve speculations, is very low. I'm much more focused right now on Canadian interest rates in terms of directional trade. I have some positions in the very front end US, and I have swap spreads positions, some positions on inflation index bonds. If you put all of in a pile, in the same pile, government debt of English-speaking countries, it's still attractive. I just don't think US is necessarily the most attractive right now. However, if you look at, so to me, one of the reasons why long-dated bonds are not attractive in the US is just a very strong historical pattern. They yield 120 right now, right? And just like in Japan, there is this unavoidable tide of Japanification, as we call it. People were trying to fade JGBs for decades, they got killed. Then they're going to try to fade bonds, they got killed. And now they're trying to fade US, and they got killed. I'm not going to try to fade US. However, the history suggests even with JGBs, on their way to the perpetually zero yield, there were massive corrections. For example, I think in the summer of 2003, there was a very big correction in JGBs, right? It was probably 100 basis points blowout on the long end. And there were several blowouts. Now, the history suggests that we had a very high likelihood of 100 basis point or more blowout in the long end of US. And I don't necessarily, and that's a lot right now. That's like a 30% drop if you own 30-year bonds. This is, by the way, an interesting aside. I always tell people, do you know that TIPS, 30-year inflation index bonds, the most protected, should be the most stable security, right? Inflation index bonds, not even the nominals, right? They traded in March in a wider range than equities.
That's amazing.
The volatility of inflation, 30-year inflation index bonds was higher than equities. So that's a pretty crazy world. So I don't think I want to touch being long 1.2% yield because I expect a blowout. In the front end, however, you could say, well, what are you going to do with 36 basis point yield on a 5-year note? You could say not much, but honestly, the chances of losing money by owning 5-year notes, I estimate it's less than 1% in the long run. If you again buy and hold, 5-year notes at 36 basis points. Well, maybe 1%. You never should estimate anything at 1%. I probably should take it back and say like 3%, right? But the reality is there is no way in the world Fed is going to hike in the next 5 years. And it's not because I am bearish on recovery, not because I think that we're starting the global depression. I'm reasonably optimistic. We will recover, we will go up, and rates will stay at zero because that's what happened every single time. And most likely, there will be even another wave of easing measures needed, and the funding will keep pressing down to like from 10 cents to zero, possibly will go negative. There were instances of negative repo trades recently, and they'll probably be pressed there. So if you own a 5-year note at 36 basis points, you probably will fund it on average, my guess, 5 basis points for the next 5 years and make 30 basis points. Maybe after bid offer, it could cost you average of 10 basis points. It depends on how well you can fund yourself. Having said that, is it the best return on capital you can get there? Maybe not, because like you buy 5-year notes for 25 basis point carry, and there could be pretty vicious corrections. But also remember, there could be vicious rallies. Even without Fed going to negative rates, there is nothing stopping due to demand from treasuries to rally to negative rates just purely on price action, just as jumping ahead, just as oil, with the oil go to negative delivery price, we can see treasuries going to negative yields even while funding is positive. And to me, that's more likely to happen at least in one point than not. So definitely the direction, the bias is still to be long at this level.
You know, we've talked a bit about treasuries. Where do you stand on equities right now?
Well, I'm a little divided on equities. So there is two things, like I would separate my opinion about equities and my strategy about equities. My strategy is very clear because my strategic system is rigorous and it tells me what to do. There is no ambiguity about what I should do equities, and I'll get to that in a second. My view on equities is divided because my experience shows me very strongly that we should expect another wave down, no matter how well we recover, how well we get over the virus. That right now we're having this pumped up situation that liquidity solved everything, but we will still hit an air pocket of earnings at some point in the next year. And that will be probably more protracted, and there will be casualties. And again, history shows that we never had a precedent of such liquidity injection. So we don't know. But so far, with some liquidity injections, we still hit lows. And even after crisis was diffused, it's very important to remember the experience, especially of 08, 09. The banking crisis, the grip of that liquidity crisis was in 08, fall 08. It was diffused when the first injection of liquidity to banks came. Bank bonds, I remember Morgan Stanley bonds trading at 60 cents the Friday before that weekend, and 95 cents Monday. That's a 2-year bond of a bank rallied over 50% over the weekend. LIBOR started to come down, things normalized. Yet we were nowhere close to the bottom of the stock market. And when the bottom of the stock market hit in March 09, we were nowhere close to the bottom of the housing market. And I'm not saying this time will be a real estate thing, but I'm just saying some shoes will keep dropping. I think that's what my observation of historical pattern. But the conflicting idea for me is that the idea that informs my strategy is that this is speculation. What we know for sure is in the long run, stocks always eventually go up. And we don't know where they will go from now. So they're off from the highs. The rates has driven to zero and probably perpetually. So any positive yielding asset has almost infinite price in an environment of perpetually zero rates. So if you think that U.S. corporate market will recover to profitability, even if it's going to have a negative year right now, what do people say? Look at earnings. Yes, earnings will be bad this year. But in terms of where it's going to be 5 years from now, because I don't know what's going to happen this year to stocks. But I do know that 5 years from now, given historical pattern, most likely we'll be back into some kind of expansion and profitability. And given lower rates, just as whole stock market readjusted to much higher levels over the last few years due to lower rates, it will probably readjust to much higher levels and possibly much higher levels and much wider PEs. And so there is a lot of money to be made in various areas on stock market. Because my strategy tends to dismiss short-term forecasts and focus on long-term forecasts, I definitely want to be long equities, but not at 100%, but at about like 50%, and pick your exposures to sections you like, with understanding that you're looking for chances to see more sell-offs to buy more stuff. But you're not looking at the moment to chase and pyramid and buy on the way up. So, but basically, rather, I would say, so to rephrase it, in the heart of March sell-off, there was a certain amount of equities that needed to be bought, certain amount that needed to be allocated to equities. From zero, you needed to go to like 50% of your risk limit or whatever it is. And then you have to stay. And then my strategy tells me to mostly stay with it now and just wait to see. And if it runs, it runs. And possibly not being at 100% if it goes up, because it seems to be reckless right now to go at 100% given how strong the pattern is. What I mean 100%, it's 100% to not 100% of your portfolio, it's 100% to what your strategy allows.
And do you have a view on global equities as well? So US versus Europe or US versus Asia?
That's not a US equity view. That's a global equity view. I actually have no positions on US equities. I'm picking and choosing on global equities. Right?
You have a view on Europe in general. Over the past few weeks, there's some more tensions are building up in Europe. Italian spreads have widened a bit. There's more talk about will there be a common bond issuance? Some people are talking about COVID could be the event that causes a breakup in the euro area. How are you looking at Europe?
So I'm very constructive on Europe. I like Europe, and this is one of the places where I like equities. I think Europe got hit hard, but Europe is coming out on the other side of it. I think Italy will be in relatively good shape very soon. One of the things is that, and I'm sorry, but I have to become a little bit of a pandemic pundit here. Areas which got hit hardest with the pandemic are the ones to really look through to the greatest economic development in the future, because my math shows me, my amateurish math, but I'm also a little bit plugged into the biotech world here in locally in California. So my opinion is that basically they have herd immunity right now in northern Italy. They probably saturated. So they will not have a second wave, or it's less likely. It's all the probabilities, but they're less likely. We're doing great here in California, almost no infections, no growth rate, but we could have a second wave. I think New York is out of the woods because they're already saturated. I think Lombardy is out of the woods, they're saturated. I think once people realize that those countries are saturated and they can reopen for business full on, oil prices are low, which is energy prices are low, it's great for Europe. And people need to go somewhere. And once the conception will restart that, okay, certain areas are now safe and epidemic is handled, I think Europe will become attractive. I think it will help them for a long time. There was this debate with Lagarde coming to ECB and everything about fiscal impulse. And I think Europe will be able to shift towards higher fiscal impulse like US, which it not necessarily will be immediately great for euro, though I wouldn't be short euro here. But if you put a gun to my head whether dollar euro will be higher or lower 5 years from now, I think euro will be higher versus dollar 5 years from now. But I don't think that's a trade. But I think Europe is going to come out better than people expect on the other side of this.
I can see where you're coming from, and that's a kind of a contrarian view, I'd say. I think a lot of people are writing Europe off right now.
Yes, I think Europe is further on the curve. It's more closer to being out of the woods in critical portions of Europe. I think political and economic breakup in Europe is no more likely to occur than in any event when people just say like, oh yeah, that's going to end the EU. I think it might actually lead to higher solidarity and cohesion. And people might say, yes, let's relax the budget rules for Italy, but nobody's going to let Italy default, just as they didn't let Greece default. Italy and Spain had horrific pandemic. I think people will let them print their way out of it, which might be slightly negative for euro, but eventually positive for stocks.
I was going to ask on China, do you have any strong views on China at the moment? Because they were the first to be hit by all of this.
It's really hard to tell about China. I've been always kind of a China skeptic. Like I believe the China economy, that it's way over leveraged and it could blow up any moment. I may have been wrong about that because this is one of the other things that pandemic shined the spotlight on. The interesting example is Hong Kong. There was this big faction in the market of people thinking that Hong Kong currency has to go through major valuation, that it's a devaluation, that it's a short. Same thing with Chinese currencies, that they were all on the edge of blowing up. Now, and I was kind of in this camp, but in a cautious way. Now, we had huge political unrest in Hong Kong, and then we had pandemic. So I'm talking about this before it hit the rest of the world, when China and Hong Kong were focused of attention. If they did not blow up then what would make them blow up, right? You just have to re-examine your views. To me, they passed a very strong stress test. Most likely they will blow up, but just because communist countries always do. But the time frame is just really hard, and I have to really, again, if such exogenous shock didn't cause catastrophic currency devaluations there, because what are they exporting now? Who is buying any of their stuff? I guess the imports they don't need to import oil or whatever commodities are cheaper. I don't know what is the net it's hard. I'm not really an expert on trade balance, how it affects the current account balance. But I think there is like this whole thread that is developing now of blame China. And when I say blame China, I'm not saying unfairly, maybe fairly, but again, I'm not an intelligent expert either, right? For covering up about the pandemic, possibly more tariffs, possibly more economic isolation for China, even them being cut off from Africa, being them cut off from US, Europe. It could hurt them in the long run. I wouldn't be long them right now. Paradoxically, they're in a strong position now. This whole region is in a strong position because they have the epidemic contained, while at least supposedly contained, while the rest of the world is still in dire straits.
And in terms of smaller markets, what things stick out for you right now?
I think generally when it comes to developed markets, you just go around and look for relative value. Okay, so rates are a little high in this country, all going to zero, so that's where the value is. Canada, where is Canada going to go with oil prices at zero? They're not going to go anywhere. The rates are never going to go up. The rates will be at zero in Canada forever, right? Those type of opportunities. When it comes to emerging markets, my strategic rule is the same. Whenever emerging markets blow up, you look for chances to buy things. Whatever the reason is, there are certain countries that are always good to buy. Like Turkey is always good to buy when it blows up. Brazil, Russia, you put your toes in the water, look for things that look cheap to you, but never with any stops. No levels to stop out. You have to be able to ride whatever you buy to zero, because the cheaper they go, the better deal they will be. So it's not something that will be ever a good trade to stop out of, no matter what the events are, no matter what is the sequence of events. The trade that you put on right now, you have to be able to hold through, and you have to be in a position that if you're buying in emerging markets, that you're looking forward to them to sell more so you could buy more. That's how my strategy operates. So my exposure to emerging markets is very cautious, similar like equities. I'm not going above 50% yet.
I mean, implicit within your kind of our conversation is kind of an optimism that in the end, markets will deliver sort of returns for you, equity markets and EM and so on. If we zoom into this year, or say next 6 months or 12 months, what constellation of events would have to happen to make you think that things are going to get a lot worse than what we saw over February, March?
I think what I'm worried about is, and what I kind of see a little bit lurking on the horizon and hope that we'll avoid, is supply chain breakdown, like a major critical supply chain breakdown. Like, for example, some food processing plants in the US closing down, right? This is like, I don't know, any person who sits in quarantine knows that. If you are a privileged person, right, you have a nice house, you have your stock of supplies, hopefully you have your toilet paper, your whatever, some durables, and you still can go shopping, right, with mask and gloves. You go buy once a week, one person in your household ventures into the world, gets your stuff, comes back. You pretty much can exist. You can work on computer. For example, everybody in my fund, we have several employees, everybody is working from home, everything is working, knock on wood. This is a serious knock on wood, but everything is operating very smoothly. No operational problems at all, with every single person working essentially in a disaster recovery mode, right? Because we're not going to the office. We're in a complete lockdown. So what happens is you're doing things okay, but then things started to accumulate in your household. Something breaks down, your laptop breaks down, you cannot have computer person come and help you, right? Then maybe like your dishwasher breaks down, you cannot do dishes. Now your life becomes much worse if you cannot have somebody come and fix your dishwasher. Now you have to like hand wash all the dishes for your full household. Things start accumulating. Now look at the larger economy. As long as seems like we can kind of running, everybody is given money to pay their bills, power is on, we can go to the stores, get food. So people who operate power plants, food processing, they're deemed essential employees, they keep working, right? But a lot of things that they need, the widgets that power plants need to run, maybe not being produced. So right now we're running on redundancy in a lot of areas. When that redundancy runs out, we can start having serious breakdowns. And that's why like abandoned households are doing okay in quarantine. People who don't have that redundancy are really suffering right now, right? As an economy, like if you look at more prosperous economies like US, which have a lot of redundancy built in them right now, we're eating for our redundancy in supply chain. That's what my fear is. We don't know where things will start breaking down, because it's all okay being in quarantine. Now imagine being in quarantine with no power. That is turned from like a vacation into, so some people being in quarantine is a vacation, right? I'm going to just sit and do my work from home and relax and watch TV. Imagine your power is off. All of a sudden it becomes an absolute nightmare. Your life becomes an absolute nightmare. I don't see it happening yet, But if you're going to start having food breakdowns, power outages, mission critical failures, and they cannot be fixed quickly because there's no, say your power plant is not working and the widgets which needed to be fixed, guess what? They're not produced. And it takes like a 6-month production chain, right? So this is where my greatest worry is. And this is where I think things can go south, both personally and global economy. And if I were in charge of policy, I would be looking very, very carefully at supply chains in the world right now.
Well, I think maybe we can wrap up the conversation now. One thing I did want to ask was if people wanted to reach out to you for your views, what's the best way of communicating with you or reaching out to you?
Well, the best way is check out our website, honteinv.com. So it's like the fund name, HONTEINV. It's like short for Honte Investment, honteinv.com. There is a lot of, we post, there's some things available for public, some clips of presentations and interviews, but to get in and register on the website, you have to be a qualified investor, and that would be a process, but people who are interested in just having some information, that's a good source.
Great. Okay. And I'll include those details in the show notes as well. But so with that, just wanted to thank you very much, Alex, for this. It was really insightful, really good conversation, and good luck for the year ahead.
Yeah, thank you. It was a pleasure. Good luck.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.